It is hard to discuss too many abstract concepts too quickly. To understand what a balance sheet is, we need to do a few examples. This is what I will do now. Let us construct a fictitious company by a fictitious owner. Let us say Alex opens a company called Laundromat Consulting. In the first step, he has to create the company. And to do so, he has to deposit some money. Let us say that he starts by depositing $200,000 of his own savings. The entries on the balance sheet would be cash plus 200 on the asset side of the balance sheet. Given that the cash came from the owner, the corresponding entry on the right side of the equation would be common stock under equity. Common stock is the most common term used when describing an owner's investment. However, sometimes you see other similar terms like stock or invested capital or simply capital. Now, Alex wants to grow his business. He goes to the bank and borrows $100,000. Now the company has more cash. And under assets, we have an additional entry of cash of $100,000, and the entry on the right-hand side of the equation will be bank debt of $100,000. Essentially, this transaction shows that we have cash of $100,000 and debt of $100,000. Please see that the totals balance. We have a total 300 under assets, 100 under liabilities, and equity is naturally the difference, and that is 200. To start his consulting business, Alex needs to buy some long-term assets, and these cost $100,000. He pays in cash. Now cash goes down in the balance sheet, and instead we have a new account that is called fixed assets. These fixed assets can be machines, computers, cars, or furniture. As you see, in the transaction, we do not touch liabilities or equity. The right-hand side of the accounting equation is not touched. Please note that our equity is not changed. When we buy assets, we are not richer. Yes, we have more assets, but we have less cash to show for. Hence, on a net basis, we are not richer or poorer. Alex specializes in technology-related consulting. As part of his business, he needs to purchase software that he will install as part of client enterprise resource planning systems. These cost $90,000 and are purchased on credit. Now we have an account called inventory, software inventory to be precise. And given that this does not pay the supplier, he will create a new account under liabilities called accounts payable. Now we have more inventory, more assets, but at the same time we have more liabilities. And this is under accounts payable. Accounts payable always denotes money owed to suppliers. If you remember in step 3, we had purchased some fixed assets. Alex realizes that he has purchased too much, hence sells part of it. $40,000 of fixed assets are sold, and as customers agree to pay Alex within 90 days. We reduce our fixed assets balance by $40,000, and at the same time, we increase the accounts receivable balance by another $40,000. Accounts receivable always means that cash is owed to us by customers. Please note that in this transaction, we are neither richer or poorer, given that we sold the fixed asset at the same price as we bought them. Please also note that the accounting equation is always fulfilled. Assets always equals liabilities plus equity. And in this case, 390 equals 190 plus 200. Now Alex is realizing that he has purchased too much of everything. He is the optimistic type. He always overestimates his capabilities. Now he realizes that he has too much of software inventory. He goes ahead and returns half of it to the supplier. The supplier agrees to credit Alex, meaning he forgives him for the money that was owed. Now for this transaction, we reduce half the software inventory account. In step 4, he had purchased $90,000. Now we return half, and that would be $45,000. On the balance sheet, we reduce the software inventory account by $45,000. And since we do not owe the supplier anymore, we also reduce the accounts payable account by $45,000. Hence, our equation has $45,000 less on cash side of the equation, so it balances. Remember, the equation always has to balance. Now, Alex receives from the customer $30,000 against the receivables of $40,000. The customer promises to pay the remaining $10,000 the following week. Now, given that the customer has paid, they owe us $30,000 less. We reduce our accounts receivable balance by $30,000. And at the same time, given that we got paid, we increase the cash balance by $30,000. The equation still balances. One account under assets decreases, while another account under assets increases. It is all still the same. Now, Alex wants inventory, but not software. He wants computers so that he can install the software on it at client sites. We will bundle the software with the hardware and sell together alongside his consulting services. He buys inventory costing $50,000. He makes a cash payment of $10,000 on the same day. The remaining $40,000 will be paid in 60 days. Here we create a new inventory account called computer inventory, and the number is $50,000. Given that we paid $10,000 in cash, we reduce our cash account by $10,000. We also now owe the supplier $40,000. And this goes under accounts payable, and it increases by $40,000. Please note that now we have a more complex transaction. We have three accounts moving at the same time. We have more inventory, less cash, and more liabilities under the accounts payable account. In the end, plus 40 on the left side and plus 40 on the right. And it is all the same and it all balances. Although we saw only 8 transactions, how does this become a balance sheet? Well, simple. We just aggregate all the accounts under each column and we will get total assets, total liabilities, and total equity. In this case, we have 385 of assets composed of cash, fixed assets, inventory, and accounts receivable. Please note that I aggregated all different inventory accounts into one under inventory. On the right-hand side, we have liabilities and equity. Please see that the equation balances. On the left, we have 385, and on the right, we have 185 plus 200. The equation always has to balance. Always, always, and always. Whether you are in Europe, Africa, Asia, or Antarctica. If the Uranians come down from Uranus, I am pretty sure that whatever accounting they use over there, it should balance also. Let us come back to the Apple balance sheet that I showed you earlier. How is that different than the balance sheet that we did in our little exercise? Well, not much is different. It is exactly the same, except that we did 8 transactions together to construct our balance sheet, while Apple does billions of transactions each year. However, the concept is still the same. We buy stuff, we sell stuff. We have payables and receivables, inventories, debt, common stock. It is all the same really, but on a grander scale. The accounting equation always has to balance, irrespective of the number of transactions. Given that each individual transaction has to balance, the sum of a billion balanced transactions gives you a balance sheet that is balanced, just like the one of Apple. Never forget, accounting is sexy, accounting is fun, let us go party.